Stock market crash. Is home buying on hold? As we think about the amount of liquidity that not only investors, but traditional homeowners need to be able to acquire their next asset or potentially even their first asset, a great deal of that wealth, Rick, is often tied up in the stock market. I am concerned that investors who haven't liquidated equities ahead of potential acquisitions could be facing a cash crunch. What are your thoughts?
Yeah, we've seen a correlation in previous cycles, Jeff, where stock market values plummet and liquidity tightens up, and it becomes a bit of a crunch for not just investors, but for traditional home buyers. If you're a prospective home buyer and watching your 401k work its way down to being a 201k, that wealth mindset that you had, that wealth mentality that you had when you looked at your savings, kind of fritters away and makes a lot of people nervous. So it wouldn't be a huge shock if we see consumer sentiment continue to decline a bit. And as that declines, you have people that are reluctant to make the long-term financial commitment that it takes to buy a house. That said, we do have countervailing forces at play in the market. We have the largest number of young adults in the history of the United States hitting that prime first-time homebuyer age of 35. That wave will continue for the next few years. So there is demand building up. And the other thing that could happen and very often does happen during periods where the stock market values go down is we could see home prices start to slow down a bit and even go negative in some markets. We might see interest rates come down on mortgages, which would make things more affordable for buyers. So there's always countervailing trends that happen during these cycles. And hopefully the uncertainty that some prospective home buyers might face when trying to make that financial decision will be offset by some of these other forces that may improve affordability and provide them with more buying options.
No, that's interesting. We certainly have a long history of stock market versus housing and how the two trend together, diverge. But my guess is a lot of that must be correlated with interest rates.
Yeah.
What kind of data do we see that, when stock market declines how does it all kind of come together to make the pot of soup that we call the housing market?
Yeah, that's probably an hour and a half video segment we're going to have to do sometime, Jeff. But the short answer is it is a complex mixture of components that helps determine how strong or how weak the housing market is. And we've touched on two of them here. One is uh, how much capital prospective home buyers might have, prospective investors might have to go out and purchase assets for the purpose of either reselling them or renting them out. That has a direct correlation to what we're seeing in terms of stock values, because a lot of people have a lot of their capital, a lot of their net worth tied up in stocks. But as the market falls, and generally that means unemployment goes up a little bit. As unemployment goes up a little bit, we tend to see the economy slow down, and that tends to be followed by lower interest rates. Lower interest rates improve affordability for big financial purchases like housing. So it really just depends on the extremes that we get to in any of those metrics. If we see the economy actually enter into a recession, we're likely to see mortgage rates come down pretty significantly, which would improve affordability, but only for people that still have their jobs. So it's kind of a moving target that we're looking at here. And again, the jury is out on exactly how much of a long-term impact these tariffs are going to have on the economy. It's likely that those people that are able to kind of stay the course, keep their heads about them in the midst of all of this volatility are the ones that are going to come out ahead when all the dust settles later on.
So, slowing economy, potentially reducing interest rates, making housing more affordable. But the big question, it seems to me, is will any of this increase the supply of housing on the market for potential investors or home buyers?
Potentially, we could see an increase in inventory, and This is actually one of the negative aspects of what we're talking about today. There are borrowers who just barely manage to be able to qualify for a mortgage and are struggling to make ends meet as it is, particularly as their insurance premiums have gone up over the last few years, as their property taxes have gone up over the last few years. And if they face economic hardship because of increased costs due to tariffs, higher inflation due to tariffs, and are unable to make their home payments, we could see these people list their properties for sale rather than risk going into default and losing their homes in foreclosure. We could also, if the economy slows down and unemployment goes up, we could also see more people actually defaulting on their loans. And those are the kind of properties that residential real estate investors often look to buy. So we could wind up seeing a little bit more inventory coming to market due to unfortunate financial circumstances for some households.
Great information. Thanks, Rick.